So 95% mortgages are back in the UK at levels not seen since 2008. This has major implications for first-time buyers, house prices, and property investors. So in today's presentation, I'll explain what's driving this change and what it means for the market in 2026. Let's get into this. Craig Parker here from Parker's Property Sourcing, just coming at you with another video today. In today's video, we're going to be talking about 95% mortgages. So what is a 95% mortgage? So a 95% mortgage allows buyers to purchase with just a 5% deposit. So this significantly lowers the barrier to entry for first-time buyers. However, high loan-to-value lending also carries higher risks for lenders and buyers also. So it's something to bear in mind. Really good to get onto the property market using a 95% mortgage if you're a first-time buyer, but there are a little bit of risks that come with it as well, So this is why I think that 95% mortgages have returns. Lenders are competing aggressively for market share. Inflation has eased and financial stability has definitely improved. So government-backed schemes and confidence in employment have supported this return of 95% mortgages. So the positive is that more buyers can now enter the market without large deposits. This increases demand for entry-level properties, increases demand that often supports or it also pushes up prices that are usually at the lower end. So it's good. It definitely make prices rise, the lower end prices rise in certain areas for sure, and it get people out of renting situations, the ones that have always wanted to buy, to potentially if they've got the 5% to potentially buy now. Just got to be mindful of the interest rate though, and who your lenders are and what lenders are lending at 95% loan to value. But the thing is, 95% mortgages do not raise prices everywhere. They mainly affect affordable areas and starter homes. So price pressure is most visible when supply is already tight. Yeah. So we've got to really pay attention to that. It's not gonna raise house prices in every single area. I'm not sure where you are watching, what part of the area you're from, what part of the UK you're from, if from the UK, but this won't affect every single area, It genuinely affects the areas that are still affordable for first-time buyers. And what this means for investors, a lot of investors are trying to get out of the market, as you know. So first-time buyer demand can improve exit strategies for investors. Investors must avoid overpaying, though, in competitive areas. So it's all about return on investment, not speculation. And this should definitely drive investment decisions in the future. A few risks to look out for, or one of the main risks to look out for, I would say, is high loan-to-value borrowing increases vulnerability to rate rises. For sure. Negative equity becomes a risk if prices stagnate. That's another thing you've got to be mindful of. And investors should stress test deals very, very carefully in this sort of situation as well. So today was just a quick update video. And my final thoughts on it is this. 95% mortgages are a tool, but not a signal of a boom. They support demand, but they definitely don't remove the market fundamentals as an investor and as I talk about on this channel. So smart investors stay disciplined and data driven. And in my next video, in tomorrow's video, we'll look at London and the housing supply crisis that we're currently in, But for today's video, really hope you've enjoyed it. 95% mortgages are back. Really good news for first-time buyers. Gives them an opportunity to enter the market a bit earlier. I've been Craig Parker. As always, till next time.